understanding ratios and accounting information to make decisions. This video is going to look at how you can use accounting ratios to make decisions from a set of data that you may be presented with. It will also show you how you can use each ratio and what the output of each ratio actually means. This will be useful if you're studying a Level 2 BTEC course or GCSE business. Firstly, we're going to look at profitability ratios. Now, profitability ratios are quite simply ratios that assess the profitability of an organisation. We tend to have two profitability ratios that we use: the gross profit margin and the net profit margin. Here I'm going to focus on the gross profit margin, and it's calculated by doing the gross profit divided by your turnover times 100. And what this shows is a percentage of profit that you make on the sale of each product or service that you do as an organisation. Ideally, you would like this figure to be higher, and of course it should always be higher than your net profit, given that your net profit takes into account all other costs. Let's take a look at the net profit ratio now. So the net profit margin is really simple to calculate. All we've done is swapped gross profit to net profit. So the formula is net profit divided by turnover multiplied by 100. And again, this shows us the percentage profit that the company makes after all the costs have been deducted. So rather than the gross profit that looks at just the cost to produce the product or service, the net profit is working out the profit you make after you take away all your costs. Your net profit percentage should always be lower than your gross profit, but the gap between these two is quite important, as we'll explain later. So let's take a look at an example and see how we can calculate the gross profit and the net profit margin. So as you can see on this example, I've got sales revenue of £10,000. The cost of sales, so the cost to make my product or service, is £4,000, and I've calculated my gross profit as being £6,000. Make sure you remember how to calculate gross profit. Sales revenue minus cost of sales. So 10,000 minus 4,000. As you can see in my example here, I put those numbers into my formula. So I know that the gross profit is 6,000. I know that my sales revenue, which can sometimes be called turnover, is 10,000. I do that bit in brackets first. Then I multiply it by 100 and I get the answer 60%. So I'm making 60% profit on every item that I sell. If you want to think about that in simple terms, if I sell an item for £1, 60 pence of that product is profit. Of course, I've not taken away all my operating costs at this point. So let's use the same data now to calculate my net profit. So as you can see, we've got the sales revenue still as £10,000, the cost of sales is £4,000, we know our gross profit is £6,000, but of course at this point I've added a net profit of £1,000. So your other costs in the business, such as your rent, your wages, your utilities, are £5,000. Now we can put the numbers into the formula. So our net profit is £1,000. We divide it by our turnover, which is our revenue, which is £10,000, and we times it by 100, and we get 10%. What does that mean? Well, the business makes 10% profit after all the costs have been taken away. You may not be so excited about that figure, but that all depends on comparing it to other information, such as past years or maybe competitors. So that's what you'll be looking for when you get an answer that you've calculated. How does that figure that you've got compare to previous years or previous competitors? So we've now calculated that our gross profit margin is 60%, our net profit margin is 10%. But what does that actually mean? Well, what we're looking for is the gap between those two figures. That 50% difference suggests that actually the operating costs in the business are quite large. And that could be a concern. That may suggest that they've got higher rent, higher wages, higher utilities. And if you were asked a question about what you could do from that information, well, you'd be trying to reduce those costs. So you may suggest trying to reduce the rent, or trying to reduce the amount you pay your employees, or try and find a cheaper supplier to your utilities bills. All those are valid solutions which you have identified by looking at those ratios. Clearly, the net profit margin is a percentage profit you want to get at the end of the business when all costs have been deducted. You want that figure to be as high as possible. So when you see the figure of 10%, you maybe want to ask yourself, as an owner of a business, would you be happy if you only got 10% back in profit for the risk you've taken? Probably not. In an ideal world, we'd look to try and find that figure somewhere like 20 to 40%. So in my example here, that figure is low, and as a result, it does suggest that some of the operating costs are too high.